Welcome to another presentation from SR Snodgrass as part of our ongoing podcast series. I'm Lenore Seifer, the Director of Human Resources, and today I'm welcoming a new guest to the podcast, Bill Hall. Bill is a Senior Manager in Tax, and welcome to the podcast.
Appreciate it. Thank you very much.
So one of your areas of expertise is not only tax, but specifically individual tax guidance, counseling, advice, and assistance with those returns. Our topic today is a big one, the One Big Beautiful Bill Act, and specifically how it relates to individuals. Or any initial words about the One Big Beautiful Bill Act? It's a mouthful right there alone.
That's why we kind of refer to it as the OB3. Rolls off the tongue a little easier as opposed to that big mouthful.
So from now on, OB3.
OB3, it works better. This situation came about, it was passed on July 4th. And we're still unpacking it from a standpoint of understanding all the nuances within the bill. A lot of different provisions that are placed in different types of tax code, different things happening. And, we're trying to make it as easy to understand for our clients and for taxpayers so that, they don't worry about making the wrong choices, because there are a lot of things that are happening that we are still trying to await guidance from the IRS. So in a way, the law has been written. However, there are nuances and there are certain ambiguities in it that we don't know. And we're awaiting guidance from the IRS to help us to help the client.
That clock's ticking, right? Tax season is coming upon us.
Don't remind me.
So unprecedented. This bill is unprecedented.
Correct.
And what makes it most unprecedented or kind of gives it that classification?
Well, the Tax Cut and Jobs Act back in 2017, TCJA, that was passed, and a lot of those provisions were set to sunset at the end of 25. So had nothing been done, everything that had been in place for the past 8 years were set to revert. So not only does it extend certain provisions, it creates new ones. And what we're going to talk about today, more specifically, are the itemized deductions, because in prior years, that wasn't a very large topic and an item to consider for a lot of taxpayers because the standard deduction had been raised. But with these new laws in place, it brings back into consideration a lot of different deductions and tax advantages that a taxpayer can take advantage of.
Okay. Well, I think that we should jump right in then and start talking about some of these high items that have caught attention from a lot of people and that you can help us understand better. Because our podcast today is really for individuals. Anyone filing a tax return could benefit from this knowledge you're about to share with us.
That's correct. So the first thing we really want to talk about are the state and local deductions. Now, in prior years, if you were to itemize your return, there is a state and local cap of $10,000. And what I mean by that is any type of income taxes you have withheld on your W-2 for state and local, property taxes, real estate taxes, those type of things, no matter how much you paid into it, you were only allowed a $10,000 deduction. The rest was lost forever. So unfortunately, in the Commonwealth of Pennsylvania, our real estate taxes are a little high. So we lost that benefit, which then put a lot of people into that standard deduction bucket. With the OB3, that actually has changed to a $40,000 allowance now for real estate property taxes, income taxes paid, estimates paid to state and local.
Big jump there.
Huge. It brings back into play a lot of clients and taxpayers who now have that ability to, because mortgage interest rates are fairly still low. So a bulk of the factor making you itemized was real estate taxes. And if you were capped at 10 grand, you're out of luck. But this kind of plays back into it. But there is a caveat, because if you make over $500,000 each year, you're starting to get limited back down to that 10,000 cap. So for a high net worth client who makes $600,000, they're capped it back down to 10,000. So for the higher net wealth individuals, this may not actually impact them. But for those in a lower bracket, yes, this may come into play.
And it sounds like there's that sliding scale then if you're between 500 and 600,000 as well.
That's correct. So there is a phase out over those courses, but once you hit 600,000 of AGI, adjusted gross income, you're out of luck, and the max you can take is back to $10,000.
Okay, so potentially some additional help for taxpayers right there then with
Absolutely. It's going to impact a lot of our clients because of, again, where we live and the real estate taxes we
Mhm.
paid. You're now being able to take advantage of that, which is kind of a nice thing.
Anything else we need to know about this part of the OB3 then?
This is only slated through, I believe it is 2028. So it's only in place
For a few years then
for a
in
few
essence.
years. Essentially, they have it written until the next administration comes in.
Any advice for individual taxpayers what they could be doing now to help prepare for that? Because it sounds like before many people would just take that deduction, so I'm guessing that there's some actions that people can take now.
That's correct. So a lot of people have the ability, and we've seen this in prior years before TCJA took effect, is almost doubling up your real estate tax payments in before the end of the year. So you've already paid it in January and it's due in January. Well, if you make that payment in December, now you get to have that extra deduction. So there is an advantage to it, with the understanding then the following year you might be out of luck.
Right. Thank you for that advice there and that extra information. So, shall we move on then? I think charitable contributions is next on our topic of discussions.
That's correct.
Is
Yes.
this a big area too that we're going to talk about?
It is, because it really comes into play for year-end planning this year in
Okay.
25, because there are a lot of provisions that take effective 1/1 of 26. And for those who want to be generous and give, it does kind of play into how they do it and when they do it. So, as a background, there are different buckets that the
Mhm.
IRS allows. So you are allowed to take up to 60% of your AGI, adjusted gross income, if you give cash donations or donor advised funds. So, for example, you go to a church, you go to a United Way, you give a cash donation, you can deduct up to 60% to make life easy. If you make $100,000, you can give up to $60,000 of deductions. Then we move into different types of buckets, and that is more for non-cash donations. You're going through your attic, you got some stuff, you
Mhm.
don't like it, it's old, you want to give it away to like Goodwill. That's subject to 50%. So you give it, you get your little receipt, you can take up to 50% of that. Then we get into the little more nuanced type of donations, and that's for highly appreciated stock. If you are lucky enough to have invested in Apple in the early 2000s, and now you're expected to pay this very large gain on that income, you have the option to donate that to a charitable organization, but it's only limited to 30% of your AGI. So as the more specific type of donations you give and the types, the lower your allowable deduction can be. And then you can get it even further, whether it be for private foundations, non-operating foundations. And that's where it's really crucial to work with your tax professional, only because you have to take into consideration the IRS has basically staggering rules as to whether or not you take this first or you take this second, and then whatever is left over, you don't lose it. It is carried forward for 5 years. So there is an advantage to taking it now, because in 26, a lot of things kind of change.
Okay.
So in 26, one of the largest things is there's a 0.5% floor that is enacted for any contribution. So, for example, let's say you have a $300,000 income for the year. Point 0.5 of that, 0.5% of 300,000 is 1,500. So let's say you give $10,000 to your charity. That first 1,500 is non-deductible. So that plays into some higher net worth, very charitable taxpayers, because the higher their income, the less bite of a contribution deduction they can take.
Interesting.
Yes, that's one of the provisions. One of the other provisions, unfortunately, is a cap of, if you are in the highest bracket, 37%. Even if you give up to that, you are only allowed to take a 35%. So let's say, for example, $100,000. You give $37,000. You're actually only allowed to take 35,000. It is not the dollar for dollar. They eliminate that top 2%.
Okay, so that's a lot of information then that people should really start prepping for now so that it sounds like this is the tax year to kind of take advantage of some of those the way that it currently is before the new.
That's correct. So there's even what we call a reference of bunching. So if you plan on every year you give in December, and this year what you can do is you can give double in December, and then that way, if you have the ability to,
Mhm.
you can double your donation in 25, so you're not subject to those limitations in 26. So it gives you more bang for your buck in the current tax year as opposed to what takes its place effective 1/1.
So far we've talked about multiple, a couple different items, and it just really sounds like you really need to look at your own individual situation to determine what's kind of best for you then.
That's correct. It's a moving target, and it just depends on the current situation that you are in and whether or not it makes sense to do it now or later, or what limitations you may be facing. And again, that is why it's imperative with OB3. And this is just scratching the surface. This is very high level. There are so many other laws and provisions within this bill that got passed that need scrutinized and understood further. And that's why it's very, very important to contact and be in touch with your tax professional.
So we have people like you helping us out then.
That's what we do.
So within charitable contributions, let's talk about what we need to know, especially for cash and non-cash donations.
Sure, because in so many prior years, this never came into play. So people would be charitable, but they wouldn't think about it because it was never a tax impact. So nowadays, what you need to start thinking about those rules again. If you give anything under $250, you need to have some sort of substantiation, a canceled check, a credit card receipt, something of that nature. Gone are the days where the church is passing the plate and you can just drop $10 in. Technically, that is not allowed because there is no proof of that donation. Now, that's under $250. If you're over $250, you actually need a written acknowledgement from the organization stating what you gave and that no goods or services were provided in exchange for it. So, for example, you write a check every month to your local, United Way. At the very end of the year, you probably receive a letter stating, hey, for the full year, you've given X amount of dollars, no goods or services were exchanged for this. That's what you need.
So
That's
not
the
per instance. So if you gave $1,000 a month, you still just one letter would suffice to recap the whole year per organization.
That is correct. Yeah. And most organizations are required to provide that notification because, again, if the IRS were to ever come and take a look, if you don't have that letter or that canceled check, they're going to deny that deduction. And you don't want none of that.
No. So that's for cash.
Correct.
What about non-cash donations?
Non cash is kind of a similar situation. Everybody drops off their old clothes or some used furniture to Goodwill. You get that little receipt. And if it's under $250, the receipt, when you gave it, the description, and a fair market value of what you gave, that's good enough. If you're over $500, then you need to do a different form in the tax return, and you're actually providing more detail of that. So it's imperative to just say, oh, well, I gave clothes. That's technically not good enough. You need to say, well, I gave 15 pairs of adult men's pants, 13 baby shoes, and 5 winter caps. Because again, there are websites out there that provide you with the current considered market value for that. That is what you need to utilize to take that deduction. And then if you're over 5,000 and you're very generous, you donate a painting or whatever, there you actually need to have an appraisal done on it. So if you're donating a car
Mm.
or something of size, there's typically a valuation needed that needs to be attached to your tax return proving that value and that deduction.
So you have some money invested in that too then to get that deduction is what it seems like.
That's correct. There's always a benefit to it, but
Mhm.
you've got to have your T's crossed and your I's dotted in order to get the deduction.
And lots of organization throughout the year as opposed to waiting until you're ready to drop off your information to the
That's
tax
absolutely
person.
correct. And if you're donating something of value, of high value, it's always worth picking up the phone and talking to your tax guy because they're going to advise you what you may need to get immediately versus what may need to be getting later.
So one of the other areas that I have seen frequently through emails and all sorts of different media, are I think it's qualified charitable donations.
Correct. So if you have an IRA RMD, a required minimum distribution, and you are over 70 and a half, if you're in a good financial position where you don't want that money, but you still have to take it, you are eligible to have that directed to a charitable organization directly, and it counts towards your RMD, but it's not a taxable event. You still report it on your tax return, but it becomes a taxable of zero. And for 2025, an individual can donate up to $108,000 of their RMD to a qualified charitable organization, and they don't get any tax against
That's a
it.
big deal.
It's huge. So if you have individuals who are very wealthy and do not have the need for that cash flow, but they're still required to take it, it gives them an opportunity to be generous and also take a tax benefit of that.
So you listed a maximum amount. Is there any minimum to that as well, or?
Not at all.
Okay.
If you have an RMD of $1,000 and you don't need it, you can donate it. Now you have to work with the actual IRA provider because they can't give you the cash and then you put it away. It doesn't work like that. It has to go directly from like a Charles Schwab or whatever to that organization. And again, you will get a letter stating what you gave, when you gave it, and that allows you to take the deduction.
Save those letters, save the
You
documentation.
got it.
Also noted that you had mentioned that minimum age too of 70 and a half, I believe you said.
That's correct. And the one thing also so if you are taking an IRA distribution, you're 65, can't do it. Got to be 70 and a half. Additionally, donor advised funds, those are the newest thing. Everybody's into them. And you are allowed to do that from a cash donation perspective. And that's that 60%. You cannot do that with a qualified charitable distribution. It has to be to an actual organization, not a donor advised fund.
Good to know. Lots of good advice with
It
that.
is. It is.
What if you can't take an itemized deduction? What happens then?
Well, there's still going to be a lot of taxpayers who don't have that state and local or enough charitable or even mortgage interest to warrant an itemized deduction. So in this case, you still go to a standard deduction, but they did increase that over the course of years. And for 25, if you are married filing jointly, you can take a $31,500 standard deduction. And what I mean by that is if you add up all of your contributions, all of your mortgage interest, all of your state and local, if you don't get above that 31.5, you go to a standard. Now, they did include a boost for individuals over 65 that allows you to take an extra $6,000 per person for a married filing joint couple. So that means you get the 31.5, and if you are over 65, both of you are over 65, you get an extra 12,000 tacked onto that. That is only for a handful of years, but you heard a lot about, well, my Social Security isn't going to be taxed. That's not true, but this is the workaround to that. It allows you an extra $12,000 of standard deduction on top of the 31.5. A lot of numbers being thrown at you,
Mm-hmm.
but essentially, and there's also additional boosters if you're over 65 or blind. Long story short, if you are over 65, married filing joint, you could potentially take up to $46,700 of a standard deduction, which for a lot of taxpayers is going to be life-changing for that tax year.
Mm-hmm. Absolutely. Anything else about those deductions? I mean, those are some big increases and some new things within there.
That's correct. The only other thing that's kind of nice is if you remember during COVID, if you gave to a charitable organization, you were allowed that $300 or $600 deduction for charity. They've carved that out again. So if you are still taking a standard deduction and you're like, oh man, I gave to church or I gave to an organization, I can't take advantage of it. Starting in 26, you can. So you may still take that standard deduction, but you can take up to $2,000 for a married filing joint as an additional deduction on your return if you were charitable. But that's only to cash donations. It's not stock. It's not goodwill. It's straight cash, but up to 2,000 married filing joint, 1,000 single.
Bill, we covered a lot of information today, and I know that it barely kind of, hits the top of some of the items that you identified as being really important to share with our audience today. And one of the things you had mentioned is that not only is the bill new, but it's, there's still some uncertainty about some of the specific pieces of the information within there. With tax season approaching quickly
Mhm.
and people starting to get ready, I mean, How does that affect all of us, and how are you here to help us then? Because there are a lot of uncertainties. What's next with that?
Sure. So just because the bill has been written and passed doesn't necessarily mean all of the details within it have been unpacked from a legal standpoint. You have a certain deduction, a certain thing that you are allowed, but once you get further into the details, like, oh, well, what if this situation, then what? That hasn't been advised on. So, as professionals across the board, we are awaiting guidance from the IRS. And unfortunately, they've had a little bit of a vacation with the shutdown, so they haven't really been focused on that too much. What that means for us is there may be a necessary need to hold your tax return before filing as we await that guidance, because obviously we don't want to submit your return on a whim. We want to make sure that we've got it on lock before we submit that return. So what that means is if you normally file in February, we may have to wait a couple of weeks until that we receive guidance and more direction from the treasury before we actually file your return.
Got it. Bill, thanks for that reassurance about, kind of how the status of everything and that
Sure.
tax professionals, again, is kind of a lot is resting on your shoulders and tax professionals in general to stay up to date with the IRS guidance and everything else as things get unpacked is kind of what I'm hearing from you.
That's correct. That's correct. There's a lot of information. It's a very large bill. It's one of the largest ones in history. And this is just scratching the surface of some individual deductions. So you can imagine how much more there is for other facets of an individual return versus even corporate or business returns.
Don't even touch on those.
We don't have that kind of time.
Bill, as we wrap up, what kind of advice do you have for our listeners and our audience about, prepping for this upcoming tax season?
Sure, there's a lot of things that are happening and it's happening live. So we're learning as we go. So a lot of taxpayers receive tax organizers and it asks certain questions. Some taxpayers fill it out, some don't. This year, those questions are going to be vital to answer because it does play into what type of donations you made, things of that nature. It is imperative to at least answer those questions. We have a lot of clients who don't feel necessary to fill it out. We just need some basic questions answered. So it's imperative to review that. And that organizer also helps you collect what you had for the whole year. You may have an investment that you totally forgot about, but you're going to see it on an organizer that you had last year. And you're like, oh, I need to get that. Reviewing that is key. Listing all of your estimated payments that you've made throughout the year. Because again, if you don't give us the information, we don't know. And if you've forgotten to provide it or you forgot you even made it, that creates a problem down the road because now all of a sudden you get a love letter from the IRS and no one wants that. And the one thing that's worth noting that took effect effective September 30th is the IRS is no longer accepting any written checks for payments due, for extensions, or for estimates. So for that fourth quarter estimate due January 15th of 26, you have to make it electronically. You have to go online to the IRS website and make that payment using a bank account or a debit card or a credit card.
That's a big thing with no paper checks because I think that initially when you hear that, some people think that means for refunds or other things, but I'm guessing based on what you're saying, it's both directions then.
That is correct. It's also for refunds. So for individuals who have historically received a paper check refund, that is no longer going to be the case. They need to provide us with their bank account info so it can be direct deposited. And honestly, that is a security factor because so many checks to the IRS or from the IRS have gotten lost, misplaced, forgotten about. If it's coming directly into your account or out of your account, there's more of a history of it and allows us as professionals to know that payment was made on that date and we've got the confirmation number, which allows us to have confidence in what we're reporting.
Absolutely. Lots of changes there. So, I think parting words then are really that individuals need to be well prepared, which this information is helping them get there, but they really need to work with their tax professionals, such as with you and your team, to make sure that they're ready for their tax returns coming up here.
That's correct. And it's one of those things where what you hear on TV and on the radio isn't necessarily true. And you can't take that to the bank. So it's good to work with people like us because that's our job.
personalized information is going to be key here too, not the general specifics.
That's
Because
correct.
I hear a lot of if-then type of statements in this information that we covered.
Unfortunately, that's most of the tax code, regardless of situation. So there's always an exception or a well, it depends kind of answer.
So, for anyone interested in continuing the conversation, I'm going to suggest that they reach out to you. I know that you and your team are keeping up to date with this information as it comes out and will be well prepared, ready to go, and contact you via email, connect with you on LinkedIn.
Yeah, that works. LinkedIn, email, smoke signal, whatever you got, I'll take it.
We also regularly provide some tax updates to clients too, so make sure that they're signed up for those as well.
It's key.
Fabulous. Thank you so much for sharing your information on this with us. Greatly appreciated.
You're welcome. Thank you for having me.
At SR Snodgrass, we're always growing. We have offices in Pittsburgh, Philadelphia, Ohio, and West Virginia. Whether you're entry level, senior level, or somewhere in between, we invite you to check us out. Go to our website at www.srsnodgrass.com, follow us on LinkedIn, and join us on our quest for the best.